Today, the structure of the silver market has shifted in a way that most participants will not fully recognize until the consequences are already unfolding. Silver futures are no longer hovering near balance. They are no longer compressing around equilibrium. Instead, price has broken decisively lower and is now trading near 84.1900, far beneath what had previously defined the center of gravity. When a market abandons equilibrium in a mathematically structured environment, the probability map changes immediately. What was once a compression zone becomes a volatility expansion phase. What was once mean reversion becomes directional pressure. And when that shift happens beneath a defined statistical mean, risk is no longer symmetric. It becomes skewed. That skew is what matters now. Not headlines, not opinion, not emotion. The probability structure has changed, and with it, the behavior of liquidity, positioning, and short-term expectation. Only recently, silver had been trading near 90.96, the daily VC PMI mean, while sitting just under 91.04, the weekly VC PMI mean. That alignment created a compression zone where price was effectively balanced between short-term and intermediate-term equilibrium. In that state, volatility contracts before it expands. The market tests both sides of liquidity, compresses range, and prepares for directional resolution. That is precisely what occurred. Price pushed upward into the resistance band between 95 and 97, testing 95.19 at the daily sell 1 level and extending toward 97.30, almost exactly at 97.31, the weekly sell 1 level. That rejection was mathematically precise. Under the VC PMI model, sell 1 levels carry roughly a 90% probability of mean reversion. Sell 2 levels carry approximately a 95% probability. The market respected that statistical extreme and reverted back toward the mean. But what matters now is not the rejection from resistance. It is the failure to hold equilibrium afterward. Instead of stabilizing near 90.96, price accelerated lower, slicing through the mean and continuing into deeper support. That transition from rejection to breakdown is the structural shift. When a market rejects an extreme and then fails to hold equilibrium, it signals that sellers are no longer merely taking profit. They are asserting directional control. The mean at 90.96 was not just a number, it was a balance line. A sustained trade below that level changes probability from neutral to negative. The weekly mean at 91.04 now sits overhead as resistance rather than support. That inversion alters positioning behavior for both short-term traders and institutional hedgers. The previous short-term cycle low formed near 84.60. That level aligned closely with the weekly buy 1 level near 87.31 and tested toward the deeper buy 2 region near 81.34 during the washout phase. Under the model, buy 1 carries a 90% probability of reversion, and buy 2 carries approximately 95%. When price tests those levels during a liquidity flush, it typically signals exhaustion. However, the difference between a test and a breakdown is whether equilibrium is reclaimed afterward. This time, instead of reclaiming the 90 to 91 zone decisively, silver rolled over again and is now pressing into 84 territory with momentum tilted slightly negative. Momentum indicators such as the 1433 MACD remain neutral to slightly negative, which confirms consolidation but does not yet confirm structural collapse. However, the location of price relative to the means is what shifts risk. When price trades above the mean, dips are statistically more likely to revert upward. When price trades below the mean, rallies are statistically more likely to fail. That is the probability inversion currently in effect. The difference may appear subtle, but institutionally it changes hedge ratios, stop placement, and liquidity appetite. Volume behavior reinforces this interpretation. The decline from 97 toward the current 84 region saw expanding volume, suggesting active participation rather than passive drift. However, the expansion appears consistent with profit-taking and repositioning rather than panic distribution. That distinction is critical. Profit-taking implies rotation. Distribution implies structural exit. At present, the data leans toward rotation, but sustained trade below 84.60 would increase the probability that deeper support near 81.34 becomes magnetized. The square of 9 geometry adds another dimension to the framework. Harmonic resistance remains anchored at 97.30, with overhead targets at 100.74 and 101.53. Those levels only activate if 97.31 is reclaimed and held on a closing basis. Until that occurs, resistance remains above, not below. Conversely, the failure to hold 90.96 increases the probability of retesting 87.31, and now that price has already moved beneath that region, attention shifts toward whether 84 can stabilize or whether the deeper 95% reversion zone near 81.34 will be tested again. This is where liquidity dynamics begin to matter more than static levels. In a compression phase, liquidity pools on both sides of the market. Stops cluster above resistance and below support. When equilibrium breaks, those stops convert into fuel. The move from 90 to 84 did not happen in isolation. It occurred because liquidity beneath the mean was triggered. Once that liquidity is consumed, the market must decide whether fresh buyers step in or whether the vacuum extends lower. Volatility risk expands in this phase because range widens and intraday swings increase as algorithmic systems recalibrate to the new distribution. Time cycles also introduce tension. A short-term 5 to 7 day cycle window appears to have formed near the previous 84 region. The next harmonic window lies just ahead. In cycle theory, these windows often coincide with volatility expansion rather than stability. That means price is approaching a zone where confirmation or failure will likely accelerate. Either equilibrium is reclaimed and the breakdown becomes a bear trap, or the inability to recover 90.96 confirms that sellers maintain control. The key concept here is not prediction, it is probability alignment. Above 97.31, resistance converts to support and opens the mathematical pathway toward 100 to 101. Below 90.96, the bias tilts toward testing 87.31 and potentially 81.34. With price currently near 84.1900, the market sits between intermediate support and extreme support. That is not neutral territory, it is decision territory. This environment is mathematically defined. The system does not interpret news or sentiment. Price itself aggregates all known information. When price abandons equilibrium, the message is structural. The compression has ended. Volatility has begun expanding. Liquidity beneath the mean has been consumed. What remains is whether the market stabilizes above extreme support or accelerates toward it. That determination will shape positioning behavior for the next phase. The breakdown beneath equilibrium is only the surface expression of a deeper liquidity transition now unfolding inside the silver market. When price moved from the 90 to 91 compression zone down toward 84.1900, it was not simply a directional drift. It was the mechanical unwinding of leverage positioning layered around the daily and weekly means. In a mathematically structured environment, equilibrium attracts size. Funds initiate longs near the mean with stops beneath buy one. Short sellers hedge near resistance with protection above sell one. When the mean fails, both sides must adjust simultaneously. That adjustment is what expands volatility. On the COMEX, positioning behavior is especially sensitive to margin exposure. As silver retreated from the 95 to 97 resistance band and then failed to stabilize above 90.96, leveraged longs who had entered near equilibrium faced immediate mark-to-market pressure. Once price closed decisively below the daily mean, margin compression intensified. In futures markets, it is not the nominal price decline that forces liquidation. It is the change in collateral requirement relative to volatility. As realized volatility expands, exchanges raise margin thresholds. That forces participants either to add capital or reduce exposure. When price is already declining, most choose reduction. That reduction becomes additional sell flow. This is how a mean failure transforms into a cascade. Liquidity below 87.31 likely contained clustered stop orders from traders who had relied on the 90% reversion probability associated with buy one. When price pushed through that region without reclaiming the mean, those stops converted into market orders. Each triggered stop removes passive bids and replaces them with aggressive supply. The result is a vacuum effect, accelerating price toward the next statistically defined zone near 81.34, which carries the deeper 95% reversion probability. However, not all declines represent structural weakness. The distinction lies between distribution and rotation. Distribution occurs when large commercial entities unwind long-term exposure, often accompanied by widening spreads and sustained volume spikes on breakdowns. Rotation, by contrast, reflects tactical repositioning within a broader range. Current volume characteristics suggest that the decline from 97 toward 84 included significant profit-taking, but has not yet exhibited the hallmarks of full-scale distribution. Open interest behavior will ultimately confirm whether longs are exiting entirely or simply rolling exposure forward. The imbalance between paper positioning and physical demand adds another layer of complexity. Futures markets represent leverage claims on metal rather than direct ownership. When price declines rapidly, it can reflect the unwinding of paper leverage more than changes in physical demand. Physical premiums, warehouse inventories, and delivery requests often lag futures volatility. If futures selling is primarily margin-driven, then physical flows may stabilize sooner than price suggests. Conversely, if physical offtake weakens simultaneously, the breakdown becomes more structurally embedded. The US dollar also plays a pivotal role in this transition. Silver, priced in dollars, tends to experience inverse pressure when the dollar strengthens. A firm dollar tightens global liquidity conditions, particularly for emerging market participants who finance commodity exposure through dollar-denominated credit. If the dollar index advances while silver trades below 90.96, the headwind compounds. Dollar strength increases the effective cost of holding metal, reduces speculative appetite, and reinforces mean failure. On the other hand, if the dollar begins to soften while silver stabilizes above 84, the probability of a reclaim attempt increases. Treasury yields influence silver through a different channel. Rising real yields elevate the opportunity cost of holding non-yielding assets. When yields climb during a period of silver weakness, institutional allocators rebalance toward income-producing instruments. That reallocation drains liquidity from precious metals. If yields remain elevated while silver sits beneath equilibrium, rallies are more likely to encounter supply. But if yields compress, particularly at the long end of the curve, capital rotation back toward inflation. Sensitive assets could support a stabilization phase. International flows, particularly from Shanghai, also deserve attention. Price dislocations between Western futures markets and Asian spot markets can create arbitrage incentives. If Shanghai premiums expand while COMEX futures decline, physical demand in Asia can act as a stabilizing counterweight. Conversely, if both futures and Asian spot markets weaken simultaneously, the signal becomes globally synchronized. Monitoring cross-market spreads therefore becomes essential in determining whether the move toward 84.1900 is locally driven or globally reinforced. The concept of a reclaim level versus a failure level now becomes central. The reclaim level remains 90.96, the daily mean. A sustained close back above that level would indicate that the breakdown was temporary and that liquidity beneath 87 has been absorbed. In that scenario, the probability map shifts back toward neutral, opening the possibility of testing 95 and potentially 97.31 again. However, each hour spent below the mean increases the psychological acceptance of lower prices. Markets adapt quickly. What was once perceived as value becomes perceived as resistance. The failure level, by contrast, sits near 81.34. That level represents the 95% reversion probability zone under the model. If price accelerates toward that region with expanding volume and does not show immediate absorption, the interpretation shifts from rotational pullback to structural unwind. Participants who believed the prior 84 low-marked exhaustion would be forced to reassess. That reassessment can intensify volatility because it removes the assumption of mean stability. A volatility trap often emerges in environments like this. A volatility trap occurs when price temporarily rebounds toward equilibrium, enticing new longs who assume mean reversion is underway, only to reverse sharply and continue lower. This pattern exploits psychological bias. Traders conditioned to buy statistical extremes often underestimate the significance of equilibrium failure. If silver were to rebound from 84 toward 90 without closing decisively above 90.96 and then roll over again, that would exemplify such a trap. The second leg lower in those scenarios tends to be more aggressive because confidence has already been eroded. Liquidity depth also shifts as markets move away from the mean. Near equilibrium, order books are typically thick, with both buyers and sellers comfortable transacting. Farther from equilibrium, liquidity thins. Market makers widen spreads to compensate for volatility risk. That widening increases slippage and exaggerates intraday swings. The transition from 90 to 84 likely reduced order book depth, meaning that subsequent moves may appear faster and more violent even if the absolute distance traveled is smaller. Institutional hedgers respond differently from speculators during such transitions. Producers who hedge output may increase forward sales when price rallies fail beneath resistance, reinforcing supply overhead. Industrial users, however, may layer in purchases when price approaches extreme support, especially if physical demand remains stable. The interaction between those flows determines whether 84 stabilizes or merely pauses before further decline. What makes the current environment particularly sensitive is that silver is positioned between intermediate support at 87 and extreme support at 81, yet still well below equilibrium at 90.96. That configuration compresses decision time. Markets rarely remain suspended between support tiers for extended periods. Either buyers assert control and reclaim the mean, or sellers press advantage and test deeper probability zones. Probability, not certainty, governs this structure. Above 90.96, the model rebalances. Below it, the bias remains negative. Below 81.34, structural risk intensifies. With price currently near 84.1900, the market stands in a transitional corridor. Liquidity mechanics, margin pressure, dollar strength, yield behavior, and cross-border flows will determine whether this corridor becomes a base or a gateway to further downside. What ultimately determines whether this breakdown evolves into a recovery phase or a deeper unwind is not a single indicator, but institutional psychology interacting with statistically defined levels. Markets do not collapse or recover in isolation. They transition through phases of belief adjustment. When silver traded comfortably near 90.96, participants believed equilibrium was stable. When price rejected 95 to 97 and then slipped beneath the mean, that belief weakened. Now, with price near 84.1900, the question is whether institutions interpret this zone as value or vulnerability. Institutional psychology operates in layers. The first layer is tactical. Short-term funds react to momentum and volatility expansion. They see a break below the daily and weekly means and position accordingly. The second layer is strategic. Asset allocators assess macro conditions, real yields, dollar strength, and cross-asset correlations. The third layer is structural. Commercial hedgers evaluate forward supply, industrial demand, and production economics. When these layers align, moves accelerate. When they conflict, markets stall and compress again. A bullish repair scenario begins with stabilization above the previous cycle low near 84.60 and, more importantly, a sustained reclaim of 90.96, not an intraday spike, not a brief overshoot, a sustained close. That close would indicate that the breakdown beneath equilibrium was absorbed and that liquidity beneath 87 has been exhausted. In that case, the probability structure rotates back toward neutral. Resistance at 95 becomes the next test, followed by 97.31. If 97.31 converts from resistance into support, the harmonic pathway toward 100.74 and 101.53 reopens mathematically. In that environment, volatility would likely compress again before expanding upward. However, a deeper unwind scenario carries different markers. Failure to hold 84, followed by accelerating movement toward 81.34 with expanding volume and widening spreads, would signal that the 95% reversion zone is being challenged under stress rather than tested under exhaustion. If price reaches 81 and does not immediately exhibit strong bid absorption, the market transitions from rotational correction into structural repricing. In that state, rallies toward 87 would likely fail beneath resistance rather than reclaim equilibrium. The psychological tone would shift from buying dips to selling strength. Confirmation signals matter because they filter noise. A confirmation of bullish repair would include declining volatility as price stabilizes, tightening intraday ranges, and improving momentum divergence as measured by oscillators turning upward while price holds support. It would also include reduced selling pressure on down days and stronger volume on recovery sessions. These behaviors reflect accumulation rather than mere short covering. Confirmation of deeper unwind would appear as continued expansion in volatility, increasing intraday range, persistent negative momentum without divergence, and rallies that fail beneath prior breakdown levels. If 90.96 remains overhead and price cannot sustain trade above 87.31, the message becomes clear. Equilibrium has shifted lower and prior support is now supply. Invalidation signals are equally important. For the bearish case, the invalidation level is 90.96. Sustained acceptance above that line invalidates the immediate downside bias. For the bullish case, failure to defend 81.34 invalidates the assumption of statistical reversion. Probability is dynamic. It updates as levels are breached or reclaimed. Cycle windows add timing sensitivity. Short-term 5 to 7 day cycles often align with volatility inflection points. If a cycle window coincides with stabilization above 84 and a push toward 90, the probability of a repair increases. Conversely, if a cycle window coincides with acceleration beneath 84, the probability of testing 81 intensifies. Larger 14 to 21 day harmonic windows typically correspond with broader trend decisions rather than minor swings. When price enters those windows far from equilibrium, resolution tends to be decisive. It is essential to emphasize that probability does not equal prediction. A 90% reversion probability at buy 1 does not guarantee reversal. It indicates that historically price reverts 9 times out of 10 under similar conditions. But when equilibrium fails before reversion completes, the historical sample changes. That is precisely what occurred when silver failed to hold 90.96 after rejecting 97. The sequence altered context. Context modifies probability. Another layer of institutional behavior involves risk management thresholds. Many funds operate with value at risk models that trigger automatic reduction when volatility exceeds certain parameters. If silver's volatility remains elevated while price stays beneath the mean, those models may continue to enforce smaller position sizes. Smaller size reduces immediate rebound strength because fewer participants are willing to commit capital aggressively. Only once volatility contracts and equilibrium is reclaimed do those same models permit re-expansion of exposure. Intermarket relationships also influence psychology. If gold stabilizes while silver weakens, the gold to silver ratio expands. A rising ratio can attract relative value traders who buy silver and short gold, anticipating mean reversion within the spread. That flow can provide support to silver even if outright sentiment remains cautious. Conversely, if both metals weaken in tandem while the dollar strengthens and yields rise, relative value support diminishes, reinforcing downside pressure. At its core, the present configuration represents a market suspended between statistical support and broken equilibrium. Price at 84.1900 is not random. It is the consequence of liquidity triggered beneath the mean and momentum following through. Whether it becomes a base or a midpoint depends on how participants interpret risk relative to 81 and 90. A disciplined framework therefore centers on conditional thinking. If price holds above 84 and reclaims 90.96, probability rotates upward. If price fails to defend 84 and accelerates toward 81.34, risk intensifies. If 81 holds with strong absorption and volatility contraction, a medium-term base could form. If 81 fails, structural reassessment expands beyond short-term cycles. The disciplined close is not a forecast. It is recognition that silver has transitioned from compression into expansion. Equilibrium at 90.96 has been violated. Extreme support near 81.34 is now visible on the horizon. Institutional psychology is recalibrating. Liquidity is thinner away from the mean. Volatility is elevated. In this environment, reaction to levels matters more than anticipation of them. Probability governs. Price confirms. Discipline responds.